Amber.
Hi, this is Team 6. I'm Li Chen Xifeng, and my teammates are He Liang Li, Xiameng, and Tian Yihe. In this part, we will focus on the stock selection and the detailed analysis of one stock that we invest. In the first part, I will briefly introduce the asset allocation of our portfolio. Because our client has a relatively high expected return in the long run and their risk tolerances are moderate, so we have deployed 50% of the equity to our portfolio and also 25% of the value to corporate bond. And this asset allocation is also based on the quantitative model that we develop in the IPS. And for the equity part, we choose to deploy 20% of the value to US large cap growth equity because it's high potential to growth and high value that we have the possibility to gain. And also we deploy 10% of the value to US large cap value because of they can provide us a relatively stable dividend and a high income. The other 25% of the portfolio are deployed to US mid-cap, US small-cap, and emerging stocks to complement the returns and the risk objective of our client. For the stock selection part, we have selected about 10 stocks in the list. And for large cap value stock, we select AT&T, Comcast Corporation, and also Molson Coors Brewing Company. They have a relatively good fundamental characteristics and a stable P/E ratio, so they can provide us a stable dividend and stable income in the future. For US large cap growth value, this is the largest parts that we invest in. We select the CVS Health Corporation and Numstone Corporation because they are undervalued in our valuation. And we think that they have a relatively good company strategy and also high potential to growth in the future. For US mid-cap, we choose Canada Growth Holdings Company and Eagle Materials because of their strong quarterly performance and relatively stable dividend yield. For small cap and also the emerging stocks, we select Aptar Group, Pro Corporation, and Anhui Province Environmental Protection Company because they have a very good company strategy to complete our return and risk objectives. In the next part, we will welcome our teammates He Liang Li to introduce the detailed analysis of CVS stock. Thank you.
Hi, let's talk more about our analysis. First, the CVS Health is located in the healthcare service industry, and after our evaluation, we set our target price to 85.50, and the recent closing price is 69.12. To talk about the CVS strategy, in 2017, the CVS decided to acquire the health insurer Athena, which allow him to gain more leverage on the bargaining of their drug price. Also, in the retail pharmacy store development plan, the CVS decided to open more new shop and move its store to some more convenient place, which is very important to the growth of sales. As we can see in this chart, the net revenue, diluted EPS, and annual cash dividends are growing steadily from 2013 to 2017. The net revenue grew from 126 to 184, and diluted EPS grew from 3.75 to 6.45. The annual cash dividends grow from 0.9 to 2. And now let's welcome my colleague Xiaomeng to talk about the intrinsic valuation.
In order to get the intrinsic value, we use the discounted dividend model. In this model, the price of the stock is equal to the present value of future dividend. And because the CVS pays stable dividend, we think this model is suitable. And here are some assumptions for our calculation. So first, it is two-stage discounted dividend model. In the first stage, the growth rate is 9%. And in the second stage, which is after 5 years, the growth rate is 8.7%. And we use the CAPM model to calculate the discount rate. In the discount rate, the risk-free rate is used by the return of the long-term treasury composite of US. And based on the going concern, we calculate the terminal value at year 5 by discounting all the dividend in the future. And based on the terminal value and the dividend before 5 years, we get the intrinsic value, which is $82 at the beginning of 2018. And we can see that the market price is less than the intrinsic value at that time. So the CVS stock is undervalued. And we recommend the investors to buy this stock. And let my partner Tianyi He to introduce another way to do valuation.
Hello everyone, I'm there. I would like to introduce another valuation method. It is the relative valuation, the PE multiples. And here we would firstly choose our peer groups. And to choose the peer groups, they are all big cap companies, which means that their market valuation is more than $10 billion. And here we just list a few of them, and you can have a simple glance. And next, we will get to calculate the diluted PE ratio, which was we get the information and compared it with the price on June 15th, just a few days ago. And here at this time, the PE ratio, the average PE ratio is around 17.27. And thus, we also get the EPS of the CVS from their latest balanced sheet, and which is around 6.52. And then we calculate the target price. You can find that this price is much higher than what we get from the previous valuation method. We just take it as a reference, and you can understand that we think the CVS price is much lower than what we expect. So we expect the CVS price to go higher in the future, and we strongly recommend it. And that's all. Thank you.